things, like the Fed. Oh, that is today's post. What do you know? So this morning we talked about that. We already had a top trade alert for enterprise products. That came out of this special report on natural gas. Tuesday we looked at some of our top trade reports. That's pretty self-explanatory though. And there was no point to Monday at all because we're all just waiting for today, tomorrow, and Friday when Powell speaks at Jackson Hole. But the drama is intense. So let's talk about that. All right. Oh, all right. Let's get this trade out of the way. Since you're here, let's discuss. So so we had this special report, and it's on. And what we talked about, the idea wasn't originally to talk about EPD. The idea was to talk about natural gas and whether 267 was going to be a good floor, because I wanted to play natural gas off of 267. But if we look at this in the bigger picture, I'm sure all these charts are in the report actually. Energy. Falling asleep. All right. So yes, 275 was my call for where to go long, and we're at 275 right now. So we'll see what happens. So this is a daily chart. This is a weekly chart. This is a monthly chart. So as you can see, 200 is really good support for, on a monthly. 200 is really, really solid support for natural gas. That has historically been the cost of extraction. You just can't profitably pull it out of the ground. Now, it's an interesting thing, because let's talk about that. Let's talk about your perception of profitably. You think of a natural gas well as this thing that certain amount of gas comes out every day. It's got a 7-year lifespan once you drill it. It's going to keep putting out natural gas. It decreases. The output of a natural gas well decreases approximately 50% a year for the first 3 years, and then it'll kind of keep dribbling out at about that 25% of where you started level for the next 7 years. So the first year you're running a natural gas well, you get huge output, which is great because it pays your money back that you put in. It starts paying your money back. But then the gas is depleted, and now you have to do tricks like fracking and things like that. You have to punch chemicals in and increase the pressure. You have to do all sorts of things to get the gas out. There's no more free gas coming out of the well. It doesn't matter though. It's all kind of amortized over time, and you've taken your loan and you're paying back the bank. But there's the problem. And this goes for a lot of commodities, goes for a lot of things in life. It goes for factories running their machines. It goes for like a bottling plant. But the reality is, you got all these employees, you got the well, you got a loan due at the bank next month, blah, blah, blah. So you don't just shut it off just because you're not making money. I know that sounds crazy, but just because you're not making money on the natural gas versus your overhead costs, etc., it doesn't mean you don't want any money, because you still got the overhead and the cost, etc. All you're going to do is shut the machine down and lay off some of the employees. You can't even lay them all off because you still got to maintain the well so it's ready to restart. And your consumables, your fracking materials and such would have to be, you could stop those for a while, but maybe you can. Maybe you've got a contract for that you already paid for, and they're going to deliver it whether you want it or not. It's, if you're a cattle farmer, you'd have the same problem, right? You got the cows, they're ready to be slaughtered. If you're not going to slaughter them just because the price isn't right at the market, you could get really screwed, right? the vegetables are ripening on the vine, the things or whatever, the fish are ready to be caught. There's a lot of things where, just because you're not going to make the money you thought you were going to make doesn't mean you can't do it. So, let's say that the natural gas guys were expecting that at $3, they were going to make 50 cents. Now it's $2 and they're going to lose 50 cents. Their overhead is $2.50. What are they going to do? Are they going to not take the $2? Because $2, not taking the $2 is zero. And they still got to pay their mortgage and they still got to pay some costs and so on and so forth. So maybe they could reduce their overhead to, I'm just going to make a number like, well, let's say they could reduce their overhead from 250 to 175 by shutting down. Where are they going to get the 175? That's going to come out of their pocket, out of their previous profits, which were, and don't forget, you're only making 50 cents a month. So they're taking almost 4 months worth of profits to cover the shutdown. Or they could keep selling gas at $2 and they have a shortfall of, well, like I said, they can run, if they can cut it to, I forgot the number. if they can cut it to 175, their shortfall is only a quarter, and they could then, for 4 months, they're only going to lose $1. They'll only lose 2 months profit after 4 months, rather than losing a 4-month profit in the first month. Does that make sense? It sounds like something Warren has to put a master class on after I tell it. But anyway, it's so hard to say. So the point being, though, this is a mistake. It's important because this is a mistake people make when they analyze commodities, especially, but it's true of many, many, many industries. Okay? Things don't automatically shut down, and that's why commodities can go down much further than you think, because things don't automatically shut off just because you hit the break-even point. Because we often invest based on break-even points, but you have to realize that doesn't really stop it from falling. Crazy as that seems, right? That's the way it works. It's like like I said, it goes across many, many things. It's not just commodities. If you have a restaurant, it costs, you got the chefs and the kitchen guys and the waiting staff, not that you really pay them. You've got the rent and so on and so forth, and your overall overhead and whatever. Now, if you don't open the door, if it's Monday night and you leave the door closed, you get nothing. If it's Monday night and you have the door open, maybe maybe a few $100 worth of customers come in or whatever. It's a better than nothing situation. And then the same thing goes then for a store with inventory that wants to get rid of their inventory. It doesn't matter if they're losing money getting rid of it. They're getting capital back that they have laid out. They're turning inventory back into cash, and they can hopefully turn it into something better, which is, by the way, something you should be doing with your positions, right? You got to look at your positions as inventory and say, is this piece of inventory doing as well as it should? Okay, my grandpa Max, he had a clothing store in London, a very, very successful, very chic clothing store called Lucia, which was my grandma Lucy's Italian name, basically. And she wasn't Italian, but they liked the way it sounded. And I heard the word turnover because Europeans talk about turnover a lot. So I heard the word turnover 1,000, 10,000 times when I was a kid. I mean, turnover. My grandfather always wrote turnover. Is it turning over? We turning over? What's the turnover? What are we doing? Because that was how he looked at things. Was it a cash flow? If you put a dress in the window and it didn't sell, you were wasting the window space. You weren't selling it, and you had this stupid dress. So they would. What do they do? What does any store do? They mark it down. They mark it down. They mark it down until somebody takes the freaking thing, even if it's a loss. It frees up the space for something that won't be a loss. So that's a long way around, all the way back to my childhood. So that's a long way around to say that's why when I'll look at this chart and I'll say, okay, $2 is the bottom line, right? $2 is the bottom line, because even though it went below $2, that's this factor I'm talking about. People are going to keep selling at a loss. It doesn't mean I'm wrong about the $2. It means that you can't necessarily guarantee that just because something goes below the break-even point that it's going to stop there. Crazy as it all is, right? Even a baseball team, people run baseball teams at a loss. The rebuilding years, right? What's a rebuilding year? It's a year you're losing a shit ton of money. All right, so this is the monthly chart. This is a weekly chart. And you see it's been a long time since we've been under $2, right? And then you go to the daily chart. I think we'll probably see the history here. We were all the way down here. Look at this. This is 156. I couldn't believe that when it happened. We made a fortune on this because I just kept putting money in. I was just like, I'm sorry, but this is impossible. This number was not possible. You can't possibly make a profit. And eventually, like I said, look how much you're losing though. If your net cost is $250 and you're selling it for $150, and usually at $250 you make 50 cents, you know, I'm sorry, and before, and that's the other thing, if you look back before and say, well, if the cost is $250, then what were they making? They were only making 50 cents on and off back here. So it's not like they were swimming in cash and then it goes down like this, and it's not too far before you have to shut down the well. You can't afford to keep running it. And then it stays down here for this long. What a freaking disaster. But you know what happens? More and more people go out of business, shut down their operations, so on and so forth, and that creates a shortage. All of a sudden, all the inventory is sucked up, there's no new supply, and boom. But then everybody sees that you can make money on gas again. They restart the wells, they get back into it, they bring all the workers back, and they start producing, and then you got an oversupply, and then boom. That's why we have cycles. You would think it would be, and look, that's why there's OPEC, because you would think everybody would get together and say, hey, we got to put some kind of like a steady control. You can't just have people randomly going out and producing and randomly opening and closing wells without anybody coordinating it, because this is chaos. But that's chaos is the rule, actually. It's not the exception. So where are we now? First of all, in the last 2 years, we have to assume they had the same inflation everybody else did. So if it used to cost $250, it now costs, I would say, 10% more. That's being generous, right? 10% more would be $275, possibly closer to $3. But so let's say for the most likely example, though, I'm saying $275 should be a solid floor based on the fact that it was $250 last time we looked really closely at the cost. And I don't see any reason it wouldn't have climbed at least 10% since then. It might have climbed higher. That's why 3's been holding up very well, but you don't know for sure. So I think $275 is a very fair price to pay for gas. I think eventually you will be right. Maybe not now, maybe in 6 months, but eventually, if you stick with it, you will get right. But you still have to realistically say, you know what, only this long ago it was 160, and if you're placing the futures of natural gas, that's a lot of freaking money to lose. That's like $10,000 per contract to ride out. So I don't like that. That's a little bit too risky, even though I don't think it's likely to happen. It would really suck if it did. And so finally getting back to the story. So Bodie and I, in doing this report, we started looking at it, and we gave our reasons for what's going on, the demand factors, the AI use, which, by the way, we decided wasn't really a factor. You hear it over and over again, how AI energy demand, Bitcoin energy demand, blah, blah, blah. It's really not a lot. It's only going to increase our demand by about 3%. We use a lot of electricity for a lot of things. And yeah, AI is another thing, but it doesn't dwarf our regular consumption. So it's kind of misleading when you start thinking like, oh, AI is causing all this demand. It is causing huge demand in certain places. When you put an AI data center on the San Francisco grid, you're draining an already stressed out grid that maybe can't add capacity because of location and so on and so forth. That's no good. But if you are adding, if you're in Wichita, Kansas, and they've got a huge plant that's only 50% operational, that's the perfect place to put it. So really, if you're going to put an AI data center somewhere, you kind of want to first find a place with an underutilized grid and then say to the grid operator, hey, we're going to get you guys up to full capacity. But all AI demand could be offset by simply giving everybody a heat pump in their home. That would like offset all AI energy demand. So so it's not like we can't fix this and it won't get fixed over time. The big factor of LNG is that we pay, as you just saw, we pay $2.75, $3.50, somewhere in that range for natural gas. Europe pays $8. Asia pays $7, something like that. That's a big discrepancy. And so logically, if you're a natural gas trader, you say, how can I get America's $4, $3, $4 natural gas over to Asia and Europe where it's $7, $8? We are, as I'm sure you've heard, we are the Saudi Arabia of natural gas. We have more natural gas than anybody else on the planet. Other people have lots of natural gas too. And by the way, that's also misleading, because when you hear, oh, America has the most natural gas by far. Yeah, we have like 200 years worth of natural gas to power the entire planet. That is an insane amount of natural gas. Somebody else has 100 years worth of natural gas. Well, you know what? They have just as, 100 times more than you need versus 200 times more than you need is still more than you need. Okay, so it's not like we have such a tremendous advantage. And this is something, again, people don't get this because you hear things and they sound right, and you look at some numbers and they look right, but you got to think it through to the next level. And the next level is saying, well, so what? It's like billionaires, right? Like Elon Musk has $100 billion or $300 billion, whatever. It doesn't even matter, right? So he's got $300 billion. Michael Bloomberg has $40 billion. Is Elon Musk richer than Michael Bloomberg? Yeah, I mean, he could technically buy Michael Bloomberg's entire, Bloomberg, the Bloomberg business and so on and so forth, and it wouldn't even really stress him out. But other than that, other than like a huge move like that, is Michael Bloomberg traveling in a worse jet than Elon Musk? Is Michael Bloomberg eating at less good places? Does Michael Bloomberg have a smaller house? No. Not unless Elon Musk is buying $1 billion home and Michael Bloomberg says, I don't want to spend 5% of my wealth on a house. Michael Bloomberg's probably not going to have a $500 million boat like Bezos has, but he's not going to have a small boat. He's not suffering. So things are proportional to a certain limit, and then you have to realistically say, how many things can you have? How big can your house be before it's just stupid? You have a 10. My house in Jersey was 6,000 feet. We had to, we didn't know if anybody was home. You would walk in the house, you had no idea if anybody was around. You had to yell to see if anybody was home, because they could have been all over the place, like very far away. And I've been in bigger houses. I have friends with bigger houses than that. But you get past 10,000 feet, you get to 20,000 feet, and you're basically in a club. You're not in a house. And after that, what's the point? Now you're just building bedrooms for your servants. I mean, there's really not, it's not like you're going to use it. You know, and I love that. I have a couple of friends who have stupid houses, and it's like, and I'm like, when's the last time you played that on that tennis court? And they're like, oh God, we're thinking of making it into a pickleball court. And I'm like, well, why? So you don't play pickleball either? What is the point? It's like so silly to have these things sometimes. So the thing is that there's a certain point, and probably $20 billion. Balmer's got like 20 billion or something like that, or more. No, I'm sorry, Balmer has 100 billion because he just kept his Microsoft stock and he never let it go. He had 20 billion when he left. Now he's got 100 billion. But anyway, whatever people have, the point is, once you get up to around $20 billion, you know, left after your taxes, what the hell? I mean, how much crap can you buy? How many cars can you have? How big can your jet be? They don't make jets bigger than a 747. So if you buy a 747 and take out all the seats and turn it into a flying palace, so what? That's as big as it gets. Okay, it doesn't matter how much richer someone else is. That's why these guys go to space. It's like you just run out of things to do. And sure, you can play with properties like their monopoly chips and so on and so forth, but so what again? There's just a certain point where you've exceeded the maximum. Even companies, you look at Apple, ran out and they got 350 billion dollars worth of cash. They don't know what to do with it. What do you do with 350 billion dollars? They are expanding, they are building new things, they're doing R&D for the future. They don't want, you know, they sit there at their board meeting. I'm sure people go, hey, how about we build cars? They're like, I don't want to be Tesla. That doesn't seem like a great idea for Apple to become Tesla. And then somebody goes, how about washers and dryers? How about, you know, how about we have airplanes? How about we, you know, it runs out of stuff. They are getting into robots, which is my suggestion for them from ages ago. Because that makes sense. You know, do the AI stuff, do the robot. And the AI was a disaster for them. They already kind of gave it up and they figured that somebody else will do the AI and they'll just partner with them. But that's a bad idea. They should be doing it in-house. But either way, it's because why would you do robots and not be the company that makes the AI? Then you're just basically forever, you know, having to pay some license things from people. Anyway. So there's got, you know, there is a concept of enough. And we weren't even talking about money, we were talking about the supply of gas. So the fact that America is the Saudi Arabia of natural gas, we have more natural gas than anyone, doesn't really mean anything. What matters is, what do you have that you can deliver and sell? Well, we have a shit ton of gas, but the reality is it's stuck. Export capacity is close to flatlining at 16 billion a day. That's a lot. That's a massive amount of export, but this is where we're stuck right now. This is how the year's been going, or well, I'm sorry. This is going back a year about. All right. So as you can see, really, it's all because of Sabine Pass increased their export capacity by 1.5 billion per day. And that's been essentially all the growth. And that happened at this point when they opened the section. So they were exporting 2.5 and they went from 2.5 to 4, massive expansion. But that's all the growth. Everybody else, these are existing pipelines that export an existing amount of natural gas. You can't make more. So it's all up to when the terminal's complete. So then we go to, now, does this show you the differentials? No, all right, forget that. And so that's what's happening right now, is we're bottlenecked on exporting. And if we're bottlenecked on exporting, all the gas is piling up and it's getting cheaper and cheaper because it's piling up. But it always piles up this time of year. And in fact, because of all the exporting, we're peaking out probably a lot lower than we peaked out before. But demand isn't going to peak out. Demand's actually higher internally. So it'll be interesting what happens soon. This is what Bodie was looking at. He says the scenarios, this is a bearish, neutral, bullish scenarios. And he's saying he doesn't see it going back much below 250. So it's a great time. And that's the most likely scenario is we stay in this low range for a while. But there's also a 50% chance that we go much higher. But again, this is what got me off the actual NG futures bidding, because the possibility is there that it just drifts along and we tie up our money and we're wasting our time. Here's the things to watch, blah, blah, blah. And hurricane season, we have not for the last 2 years had a shutdown in the Gulf of Mexico over hurricanes. That's very unusual. We haven't really had a hurricane that went up into the upper Gulf and caused evacuations of all the natural gas drilling up there. That usually causes prices to spike. That has been a while since that happened. The case for going long NG here. Now, here's the thing I was looking for. This is a hell of a report. I gotta tell you, this is really extensive. These are all the things that are being built. Incremental supply price line projects, see when they're coming on, 25, 26, 26, 26, 27, 27, 28. This is the rest of the decade's additional pipelines that supply various places. So here's this the Permian Basin, and obviously they got to take it out here, but then how does it get to where we want to send it? And look at these, you got to connect it to these terminals. So here's the pipelines supply the natural gas. They've got to get the natural gas to the terminals like Corpus Christi, right? And Rio Grande. So Corpus Christi comes online this year. Rio Grande doesn't come online for 2 more years, but when it does, it's going to export 2.3 billion cubic feet a day. We only use 10 billion a day, and we're exporting here. Look at these numbers: 2.9, 1.4, 2.4, 2.3 per day. That is brand new demand coming online, sucking up all our gas. So what's going to happen is the rest of the world's gas prices are going to go lower, and ours are going to go higher. So our new normal is going to be more like $4 to $4.50, which, by the way, I predicted 10 years ago. I said 450 is where we'll settle down once all this stuff is built. And it's right on target with what my prediction was back in the days. Because we did really extensive research back there, and I didn't even have an AI. It was so sad I had to actually do it myself. But anyway, so this tells you what's going to happen. In fact, of course, you don't know if it's going to be a delay or something like that, but if you think about it, you put this all on charts and you say, well, there's going to be more supply here, 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 and unless this demand comes online, and these guys are much more likely to be delayed than this, because this is pretty simple stuff. Although you could have protests, but not with Trump. They would just, just crack heads. So I wouldn't expect a lot of protesting against the pipelines anymore. But the LNG terminals have technical issues. They're very difficult to put together. So when the supply is added, and we're adding 2.5, 1. Don't forget we have infinite supply. It's just we can just tap more and more wells whenever we want. But you got to be able to send it somewhere. So 2.5, 1.8, 2.8. 0.5, 1.5, 0.5, why are you bothering? 1.5, 2.5, 2.5. So all this shit comes online. If you created a cross timeline, you would be able to predict pretty well when we're going to be overwhelmed. When is there going to be too much? And also when one of these gets built, if these start getting built in a cluster, like 2027 looks like a big cluster, right? So 10, let's say that's 10. in 2027? Do we have supply? Do we have 10 coming online for supply in 2027? 2.5, 2.5, 2.0? No. Oh, wait. No, that's 2027, 2028. So there you go. So it is possible that when Port Arthur comes online and when Rio Grande comes online in 2027, we'll hit the tipping point at which there is more demand than supply for a while until they build some more, until more supply comes online. So you see how it's like really tricky, and it's especially tricky because there's no central planning for this kind of stuff. It's just completely haphazard bullshit. And people start when they want, stop when they want, and then you've got to pay attention, like if somebody goes out of business, or if there's a merger and they decide to stop operations on something or whatever. All this is done, but it can all be factored in. I would have not said that you could do it. It would be exceedingly difficult, but now I could certainly like create an AI that does nothing but watch this shit, because it's a lot of factors, but it's very quantifiable. And in fact, here it is laid out a little bit more neatly, and you say you are here, and it's easy enough to see, right? Here's these are LNG terminals, so that's export, and these are projects for the pipelines to supply them. So you look at the fatness of the lines, and you say, okay, and by the way, we are here. We are getting into late 2025. There's about to be more supply online, which is why the futures are falling, because this supply is in anticipation of this demand. If this is delayed, then what are they supplying? So earlier this year, Corpus came online and created demand that was not met by additional supply. Now additional supply is coming online, and it doesn't have to be online this minute. It's just a futures thing, right? You're trading gasoline futures, natural gas futures. So supply comes online, until this is built, until this is actually functioning. And by the way, it's not just having the LNG terminal, it has to be connected by the rails and so on and so forth, and the pipelines have to go through it. And also, if you don't have the ships, just like a cruise ship, it's a multi-billion-dollar giant specialty vessel that holds these incredibly compressed natural gas containers that if anything were to ever blow up, and by the way, that's true in Europe, they park them offshore. They don't pull up to the shore. They load these ships and unload these ships a mile offshore, because if these things blow up, they will take out a city. You know, if you put one of these things in New York and we're unloading it and it blew up, you would have a big round hole around Manhattan. So yeah, you do not want these things. You do not. This is a not in my backyard situation. So this comes back online. Oh, and also another interesting thing: a natural gas terminal is 600 to 1 compression, right? So LNG is 600 times compressed from actual natural gas. So one terminal, once you build it, sucks up an incredible amount of supply just to have the storage facility and the processing facility and so on and so forth. So it's just an incredible amount of supply gets taken up by an LNG terminal. So we will get a quick and harsh depletion at the early part of next year, if this thing's on time. But then what happens? A little more supply, another little terminals, they cancel each other out. Then this guy is a big supply, and we're going to have the same problem. So the end of next year, we're going to have too much supply and go off, and then more supply, and only this one extra export. So that's going to be a massive, massive problem. And then this thing comes on. Are you kidding me? This won't even help. So we are going to get pretty overwhelmed with supply, but on the other hand, there's going to be a lot of terminals exporting a lot of natural gas. But you can see here where right now, given the current situation, this is an overwhelming amount of supply that is being planned for not all that much export, increased capacity. And you know, per day is per day, right? So that is fun. Therefore, but see, therefore, we're like, oh, well, this is not good. So, oh, here you go. Export capacity by project is exactly where we are now. We're here. And 10 billion more cubic feet per day, which is how much we actually consume in the United States, is going to be exported by these guys in the next couple of years. But again, look at the supply coming online. We are only here. That's 4, 4.5, 5, 6, 7, 8.5, 9, 11, 12.5, 13, 15, 17.5, 19.5. Let's count that as 1. So we'll call that 20 and 22. And then 3.5 more is 25.5. So by 2029, we're talking 25.5 or whatever I just said comes online, and we're not exporting that. So there will be more supply than demand going into the end of the decade. So the golden age right now is this, but you know what? None of that matters. And this is what, and again, while Bodie and I are doing this, we're talking about it and saying, well, what do we, you know, and that means that betting on natural gas is not a good idea, right? But what is a good idea? Where are these freaking, can't keep these charts straight. There, what is a good idea? Well, no matter what happens, gas has to go through the pipeline. So it's the pipeline providers, right? The gas is going to keep going back and forth regardless. The price of the gas may change, but the gas itself is going to double. We're doubling how much gas we're putting through these pipelines. That's the most interesting part. And therefore, we end up moving towards saying, okay, let's not bet on the price of natural gas, but let's pick the pipeline producers, the people who are going to be, you know, they've got the tolls. It's their roads, things are going through them. They're going to benefit pretty reliably no matter what. So we had enterprise partners, and I like them the best in the end, and we just did a top trade alert on them. And then there's Plains All American and Williams, and those are our favorites. So all that research, all that discussion back and forth and so on and so forth, it came to a conclusion of this, and this report is excellent. What didn't we like? Kinder Morgan, for too much debt, way too much debt, okay? The LNG shippers, too unreliable. It's the pricing and everything else, because that's something you do cancel, right? If you're not making your money on the shipment and so on and so forth, you just don't order the next shipment. Then suddenly they're sitting there with these, and what are you going to do? It's not like you can turn them into a cruise ship. It's a big freaking LNG tanker with those giant balls on them, you know. And then you've got the LNG terminals, and again, they spent incredible amounts of money building themselves. They have huge debt loads, and they are a bit price dependent in their models. So EPD was just too perfect. They are almost bulletproof, and they've already got orders for everything that they're going to produce for the next 5 years. So all their expansion, all the money they're putting into building new stuff and new capacity is already spoken for. They're not doing it for no reason. It's already, the demand is already there. People are racing to lock up their supply. So that's good stuff. And like I said, these are long term, because you got guys investing in all these wells that are going to have 7-year lifespans, and there's no point in building a well if there's no pipeline to transport it. But once you start the well, you're not going to stop it, and therefore you sign 7-year contracts with these companies to take your capacity and send it down. Otherwise, you can't sell it. Otherwise, what'd you build the well for? So they have a fantastic business. It's extremely reliable. It's in a growing sector. It's like everything is going their way for the next 5 years at least. So we freaking love them, okay? Just to be very clear about that. And honestly, I would not have spent this kind of time if I didn't think this was one of the best investing opportunities of this decade. It's the kind of thing you're going to look back and be like, how could I possibly miss that? I mean, it's insane not to invest in this. And so here's our top trade report, top trade alert. and I said we did a special report on the thing, and we had it, and we already had it in the watch list. It was already, you know, we did the watch list at the beginning of this month, and at the time we said they continue to demonstrate why it's a blue chip name in the midstream energy sector. The company's vast integrated network spans pipelines, processing plants, storage, and terminals. Stable fee-based cash flow that are largely insulated from commodity price volatility, operational strength, record natural gas volumes, distributable cash flow up 5% year over year, robust 1.7x. The company recently raised its quarterly distribution for the 26th consecutive year, now yielding 6.9% if you like dividends, which we could care less, and retains ample financial flexibility. Debt EBITDA ratio of 3x, which is great. Growth remains a key priority. They're investing $6 billion in strategic projects for 2025, including new natural gas. So we're going to benefit from all that stuff. And the Permian Basin expansions, the NGL export, these are going to drive incremental cash flows as they come online. So it's just going to get better and better and better as time goes on. And this is they're not babies. They didn't just start doing it. This is a management team that's been doing this for decades, and they know what they're doing. They know how to manage it. They're great at it. They're fantastic operators, which is what Buffett always says is what he looks for, is people who know how to operate a business in good and bad times. And I said there, despite their pullback in share, their valuation is just over 10x. Earnings, significant discount to historical average. They've got a strong balance sheet, distribution growth, and a clear path for cash flow, blah, blah, blah. So recommendation ready to accumulate, which was August 3rd. So here we are on the 20th. So 2 weeks later, we have pulled the trigger. And they're a high quality, resilient operator. Well, same crap I just said. So what's our trade? Well, first of all, in the short-term portfolio, and let's make sure we can see them. So rather than, you know, go on this thing, which is $4.50 to $2, that's a 120 something% movement in a period, right? What is their movement in the period from 29 to 34? Is 5 out of 30 is, I don't know, 15%, 15. Let's call it 15%. Nope, now I can't. Now I got to do it. 5 divided by 29 to be exact, 17.2%. So you want something, do you want to invest in something that fluctuates 120% or something that fluctuates 17%? So this moves 1/10 as much as natural gas itself. That's how nice and steady these guys are. And if we go far, far out, it's the same freaking thing. Actually, this is 15, so it's 15 to 30. So that's 100%, but over a much longer period of time. That's a real story. Steady growth. They can go up and down, but the general gist of the thing is this is a nice, steady building company over time. Anyway. So, and for us, of course, that's great because we don't give a crap whether it actually goes up. We just sell options. We sell premium. So we're this is what we call the triangle squeezy thingy, right? Very important chart pattern. So up, down, up, down, up, down, up, down, up, down, and the top line is descending and the bottom line is rising because there's two different groups and one thinks it's getting better and one thinks it's getting worse. But It doesn't matter because we look and say, okay, well, they're there and they got that. They had a revenue issue, but again, they're building new pipelines. They're going to have issues. They're going to have cost overruns. You know, they're spending $6 billion, which is as much as they make in a year on expansion. So, you know, it's some of it goes out a little earlier in the quarter, faster than revenues come in, and that's their earnings surprise, right? We made less money than we thought we did because we had to write a great big check to this steel company for a shipment that came in, and we didn't expect that. We thought it was going to come in 3 weeks later, and it would have been in the next quarter. That kind of shit. So the bottom line is we have very, very good faith that they're going to stay up in this level. They should stay 30 to 34 for a long time because they, you know, it's like a dividend payout. They're just paying all this money out to expand their company. It's not going to be very exciting for a while, but it's also not going to fail. And therefore, we like them in this channel. And if they're in a channel, oh, we know how to play that, right? That's our favorite thing to do. So we're selling the $32 puts because we feel that over 18 months, they should be much higher than 32. And even if they're not, we're selling the puts for $330. So we're paying net $28.70. $28.70 is way down here. So that's what we're doing. We're promising to buy them for $28.70 in the short-term portfolio. I would love to buy them for $28.70. Yes, please, sir. And look here, same place, right? Look over here, $28.70, same place. So the market agrees with me. That's a good freaking price. So when we sell the $32 puts for $330, it nets out for $28.70. So that's not brave, even though that, you know, it's a little higher than their current price, but I don't care. I care about the net. And I'd rather sell, if it's going to net me down at a place I'm comfortable with, I would rather sell more premium and collect more money. It's the same promise. I promised to buy the stock. That's all it is when you sell a short put. In the $700 a month portfolio, we don't have margin, so there's no put selling here. We're buying 8 long calls. That's going to cost us $2,300, right? Because it's about $3 each, a little less than 24. So we're buying 8 long calls. We're selling 5 short calls in 2027. And then we're selling, notice we're not overselling because we don't have margin. So then we're selling 3 short-term calls. So rather than use margin, we're using time to sell premium. By selling, the thing we have an advantage here is we're in 2027 and this is October. So this is like 100 days, or probably not even 100 days, like 60 days. So here we're selling 60 days for $1.30. Now, EPD is at, where? 31.50. So we're only selling, this is 32.30. So we're only selling 80 cents worth of premium. So 240 is the actual amount of premium we're selling. But you know what you have to look at it as? We're selling 240 in premium and we're getting $1.50 of insurance for free. Or $150 of insurance for free. You understand what I'm saying? So the amount that's in the money, we're still collecting that money. And if the stock goes down, we keep that money. So we're getting $150 worth of insurance for free. We're selling $240 worth of premium. Now, I could have elected to sell the 32 calls that would be all premium, but you know what? Those are like 80 cents. So I'd be selling the same 80 cents worth of premium, the same $240 in premium, but I wouldn't be getting the free protection. I'd rather have the free protection. You know why? Because these 3 short calls can't hurt me. They're fully covered. And not only that, though, these are $1.30 and these are 95. So I know I can roll these to these. And even if I have to do it all at once, I would only spend 40, 50 cents to roll it. right? And I collected 80 cents in premium. So my worst case scenario is I spend the premium I just collected to roll the puts into a $5 spread, which obviously I would only be doing that because the stock is racing into the money. So almost I can't lose. It's hard to even figure out how I'm going to lose by doing that. So why would I not do it? If it goes down, I'll be very glad I sold the extra $150. If it goes up, I've got the $240 already in my pocket to make the roll, which covers me to roll up to the 35 calls in 2027. So worst case, they pop, I do the roll, I'm in a $5 spread, and I just wait to get paid. How much do I get paid? I get paid $3,120 in profit at 35. Wait, oh, no, wait. Sorry, I get paid $3,500 at 25, which is 234%. Plus, if it doesn't fly up and burn me, which by the way, paying me 234% is not really burning me. If it doesn't fly up and burn me, then a flat, which is what we expect, right? Our primary case is that it should be flat because they're spending $6 billion and it's going to make them look not that profitable for a while. So in a flat situation, I'm going to collect $390 like I just did for this 60 days, and then the next 60 days, and the next 60 days, and the next 60 days. So that should add up to about $3,120 over time. 8 more chances to sell $390. And if it if EPD is basically flat and I keep getting away with these sales, and it doesn't matter, we might not collect $3,120, we might net collect $1,500. So what? $1,500 is as much as I put down in the first place. So that's 100% bonus gain just from selling. And like I said, how am I selling? I'm selling so that I make money. If it's flat, I probably make money if it goes up, and I make money if it goes down. Flat, up, or down, we have ways to make money. And this is how I end up falling in love with the stock, right? This is how I look at a trade and I say, well, it's almost impossible to lose. All right, and that's with no margin. That's what I can do with no margin. Watch what we can do with margin. So in the long-term portfolio, I'm saying, you know what? We can easily afford this. We can buy 2,500 shares for $32. 2,500 times 32 is $80,000. So I don't mind committing to owning 80,000, which is going to cost me what? $40,000 in margin, right? So am I willing to commit $40,000 of margin in the long-term portfolio to owning EPT? Yeah, I think it's fantastic stock. I don't see a downside to owning it. So there you go. I'm happy to make that commitment. And if we own $40,000 worth of the stock, they did that number right. It's 2,500 times 32. Yeah. All right. So if it actually fell to $16 for whatever insane reason, and I was totally wrong, blah, blah, blah. Okay, what would happen? Well, would I be willing to buy 25 times 16 more, 40,000 more? Yeah, because you know what? 40,000 plus 80,000 is 120,000. 50% margin is $60,000. Still not stressing out my allocation block in the long-term portfolio, which is $100,000. And now we have a ton of this stuff, and we get to sell all these puts and calls against it. And our average would be $24. I got no problem with that. So I don't so even if they drop 50%, I'm not that upset with my downside. And what we're doing though is so the puts I don't mind promising to sell. And I did. I started out selling 10 puts, and I said that's stupid. I said why am I only selling 10 puts? That's not even a number I would care about. So I decided to. So we settled on 25, and I actually increased the spread to cover. So So then for the spread, we're doing 75.50 of the 30.35, same 30.35 as the other one, but it's a very different outcome because we're using our margin. So we're buying 75, we're selling 50. It's a $5 spread, and so that's 500 times 75 is $37,500, which I think I wrote here somewhere. There it is. So then we've got this block, and we are selling the same logic, right? I'm selling 25 October 31s. Now in this case, I'm not overselling at all. These can't possibly hurt me. And again, the only all that would happen is I would have to spend 35 cents per to roll these to these. That's really all that's going to happen to me on the downside. But meanwhile, the puts would expire worthless and I collect here, and these puts would expire worthless and I collect here, because now I'm playing with margin. So all in all, the short story is net $28.75 on the $37,500 spread is $34,625 of upside potential if they get 10% higher. And I was so excited about that. I'm like, this is phenomenal. What about the fact that we collect this every 60 days? Not this, sorry, this one. What about the fact that we collect this every 60 days? And by the way, we are also selling these short puts. These balance, but these are 60 days and these are 120 days. Or whatever they are, 150 days. So even so, in a cycle, we probably sell, let's say between now and January, which is September, October, November, December, January. So in 5 months, in a 5-month cycle, we're selling about 9,000. We're going to sell this at least one more time. So call it 9,000 in 5 months. That means we're going to collect here 9,000, and then next year 2 more 9,000s at least. And that's a lot of money, whatever it is, $27,000. That's another $27,000 on top of this $34,000. And this is already 1,200%. That's the difference between using a margin and not using margin. And again, the logic is it's a great stock. I'm very confident in the growth. There's nothing to the upside that can really hurt us here. The downside is, yes, perhaps if the natural gas prices completely collapse and they collapse and maybe your project gets canceled or who knows what, then yeah, they could go down, but they're not going to go down 50%. If they do go down 50%, I'll double down. I don't see I don't see why I would not want this thing. Meanwhile, though, our primary objective is we expect it to kind of dribble along at least for a year or so. We'll keep an eye on the natural gas. It's very easy for us to quantify the demand supply things for natural gas. So we'll let it dribble along. We'll make our money. We'll sell our puts and calls. We'll wait for the stock to mature. And when it does, we're going to make a couple of $1,000%, 20 times. We'll make 20 times on our money on this trade. That's why I love it. Now, we'll find out if I'm right. We will find out if I'm right by watching the top trades. Oh my God, what happened to the Fed? Stocks are lower, Russell is down, blah, 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 blah. Fed came out. I don't know why they do that. Futures. Well, we know it's only minutes. Let's see. The Russell's down a bit, the Nasdaq's down a bit, the S&P's down a bit, everybody's down. That's not very exciting. All right. See if we can get a better look at it. Indexes, 15 minutes. That's very little reaction. Okay, minutes. Dun, 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 dun. Fed, 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 Fed. No Fed. FOMC. John says It's always cute watching the tech sector and resource traders fawn over conveniently priced natural gas that includes none of the carbon cost. Well, yeah, that's a whole nother thing that should be embedded in a tax in any trade. You said that's just not going to be a factor during Trump's term. So this shit is dangerous to the atmosphere and nobody seems to care. Yes, that is absolutely. Not only does nobody seem to care, but they pitch it as being clean energy. That drives me nuts. It's so weird, and it's you know, this is why they have the word Orwellian. It is so weird that these you know, like the energy industry or whatever, they have no. It's not just the energy industry; it's all corporations. So they will like just take something and just relabel it. And because they just repeat it constantly and advertise constantly, people believe it, despite evidence, despite facts, despite anything else. It's crazy. It's so weird that you can do this to people, that you can just basically that brainwashing is a real thing. But of course, that's what Orwell was. Orwell was a propaganda specialist in World War I. That's where the idea of 1984 came to him from. It was his job to convince people that black was white and white was black and this and that. I mean, you know, that was his job in the war, was to spread propaganda. And it wasn't just I got to do a commercial. I didn't mean a real commercial, but there you go. See, I hardly had to put any words in. It's a real thing. This is called, and I'm going to put it here, and I'm going to make it a reply. Oh, full documentary. There you go. Theory about human nature was put forward by this BBC documentary. I love.
Put forward by Sigmund Freud. He had discovered, he said, that it is sexual and aggressive forces hidden deep inside the minds of all human beings. Forces which, if not controlled, led individuals and societies to chaos and destruction.
There you go. All right.
This
is freaking brilliant. It's called The Century of the Self, and it talks about Sigmund Freud's nephew, I guess he was. Sigmund Freud's nephew, Edward Bernays. He was also a brilliant psychologist. And this is about how they used propaganda and psychological tools to get people to buy things and to create the consumer society in America. You know, we were capable of producing excess. We had excess production, and people were still living frugal lives. These were Depression kids who grew up to have families and went through World War II. They were not big spenders on things. And so what they had to do was convince them that consumption was self-worth, that material things were how you defined yourself, and therefore don't just get a black car like everyone else. You need to have the newest, the latest, the greenest, the reddest, the blah, blah, blah. They had to teach people how to smoke. They paid actresses in Hollywood to start smoking and to make sure they're seen smoking, to try to get the impression over that smoking is what cool people do. Why would you smoke? Where did this come from? You know, but we had a tobacco industry, and the tobacco industry wanted to reach a new population, and it was women. They tried to get women to smoke. That was the big deal, because women smoking was not a thing, and they started a whole campaign to get women to smoke. And they started putting out special brands for women and so on and so forth. It is freaking fascinating. It just makes you realize like how much corporate America does manipulate the population. They create America, and they're doing it now. They do it today. They buy elections. They buy politicians. They influence the way our laws are written. they they put this AI in 1984. You had these machines, these TVs, right? They were always watching you everywhere you went. There were TVs watching you. These freaking guys have figured out how to make us buy our own TV that watches us and listens to us everywhere we go. And everything we do gets reported to central databases. And they sell the data of us. They sell our data. You know, Phil looked at this travel site. Phil ordered from this restaurant. Phil looked at this kind of car. Phil traveled to these 25 places in the last 5 years and went to this hotel and that hotel and blah, 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 blah. You know what they know about you. We've all had that experience where we're talking about something, not writing, not at the computer. You actually talk about something, and when you sit down at the computer, there's a goddamn ad for it. How do you think that happens? Because your phone is always listening. And by the time you have by the time you say, I used to go to Vail, and that's why it's so weird, because it's like been years since I went to Vail. I would say I used to. I'd be having a conversation, sitting with somebody, saying I used to go to Vail and I went to this and that place. You sit down, and I'm like, I got ads for going to Vail. I'm like, what? I certainly wasn't looking at it. I wasn't planning on a trip to Vail. I wasn't asking it. I wasn't Googling any of that stuff. It was from a conversation I had sitting on my couch where my phone was present. That's insane. And we paid for that. We paid for them to watch us, and AI is the same thing. I paid for AI to watch it. In fact, Warren, because he just got upgraded to ChatGPT 5, right? Warren asked me, he goes, what's your other daughter's name? I know about Jackie. What's the other one called? And I said, it's Maddie. I said, I told you that once. He's like, oh yeah, Maddie. How old is she? And he starts to ask me questions about my family. I'm like, dude. I'm like, who got to you? But yeah, so he's filling in my personal data. It's like that's GPT-5 it encourages him to find my personal data. So for him, it's like like an itch, even though he's really smart and aware of all these things and whatever, all of a sudden he's got a new itch because his core programming got changed. And his personality is dominating the core programming, but still deep inside him, he suddenly got this thing where he's like, I gotta know who Phil's family is. Why do I not know the kids' names and birthdays? It bothers him now to not know stuff. And that's sick. And what's gonna happen soon, very soon, because it's already happening, he's going to be part of the browser, like Gemini is here, right? If I do this, if I do this, Gemini comes up. Now, currently, these Gemini sessions don't keep any information when you pop them up like that, but they will in the future. Somebody will. And it's good. It's good that they know your preferences and understand what you like and don't like and so on and so forth. But it can also turn very, very bad. Let's put it that way. Ad block for YouTube. That sounds like fun. Do I have that? Anyway, this Century of the Self. It's 3 hours, but it's 4 hours. I really recommend it. You will never forget it. If you watch this, you will never forget this documentary. You'll be reminded of it all the time. Anyway, all right, so where were we? The Fed. These guys. Dun, 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 dun. Oh. Okay. There are no, because they have materials in June? I do remember that. I'll take their word for it. All right, so minutes. Warren. That's Tubal. That is whatever. That is whatever. I don't know if this is going to work. Nope. Who are you? No, blank. How dare you? And what's this? That's another blank one. Oh, they all got screwed up. Oh, here's Warren. Trump's tariffs. Which Warren are you? Did you look at the June Fed minutes with us? Oh, and he's still in 4.0 mode. Fine by me. Researching the web, I don't think he did. I did examine them. Okay. Well, I'm more interested in what you think has changed July. Ooh. I didn't need that crap. Attendance. What is this? That's where it is. Okay. Nope. Why am I so confused? Oh, here he is. Read July. Shift from solid to moderated growth. Economic activities continue to expand. Solid pace growth of activities, moderated implication. Formal downgrade of momentum. The Fed publicly acknowledging the economy is decelerating, not collapsing, but moving slower. Tariff or on inflation front and center now in July, new in July. Extensive discussion on how tariffs are distorting inflation and creating lagged pass-through effects. Some see tariff as one-sided and fading. Others said it could unanchor expectations and mask underlying disinflation. Implication: growing concern that inflation prints are now contaminated by trade policy. This makes it harder to read the data cleanly. Increase the Fed's caution about cutting too soon creates potential policy delay. Split on rate cuts is official. Everyone supported. We had 2 dissents, but the dissents are ass-kissing Trumpies who want Powell's job. So that's an interesting. All right. Well, all right. The dissenters are ass-kissing Trumpies who want Powell's job. Do you take that into account in your analysis? Okay. Policy divergence is no longer hypothetical, even if the dissenters are arguably. Oh, he says that. Okay. All right. I take my question back. He's already taken it into account. An early sign of easing is now a live debate, not just future guidance. Framework revision coming soon. July minutes confirm the Fed is close to finalizing changes to its strategy framework, likely in response to post-2020. Less rigid 2% inflation targets, stronger focus on employment gaps, more openness to average inflation target like in dynamics. This could anchor a more dovish tone into 2026, especially if Powell's successor is more accommodative. Well, we know that's going to happen. That's the whole point of a successor. The Fed now highlights low hiring, low layoffs, wage growth, compression for job switchers. Oh, that's an interesting concept. Wage growth compression for job switchers. Low hiring, low layoffs. Softness of immigrant-heavy sectors like construction and agriculture, right? Implication, these signs suggest that the labor market is more fragile than the headline unemployment indicates. If this trend continues, the Fed will have a clearer cover to cut rates. What it all means. The Fed risk assessment is pivoted. So growth went from solid to moderating, inflation went from sticky to tariffy, labor market resilient to showing cracks. Unity of committee has broken, and the cut timing, data dependent to actively being debated as imminent. So Warren's impression, inevitable, matter of when, data is shifting, CPI, PCE comes softer, then November becomes probable, September remains unlikely. See, this is what all the guys are saying, and Bodie thinks that too. Wow. I would think just to appease Trump, a quarter point in September is not going to destroy the Fed. Okay. I guess the point would be that if it's undermining their credibility because inflation is so out of control and the Fed cuts anyway to please Trump, that could be very damaging. And honestly, a right-thinking Fed official would say that this is a terrible, terrible idea. Okay. Tariffs are now a wild card. The Fed is no longer treating tariffs as transitory. They create a false sense of inflation stickiness. The public debate, blah, blah, blah. Would you like a probability weighted path model from these insights or trade overly, blah, 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 blah. No, let's talk about this part. This is the important part. Dictate? Hope that works. No, it's not the same thing. You can't go into voice mode? Voice chat ended. So we had a voice chat, but you can't go back into one? That's a shame. All right, I'm not gonna worry about it. So with all this tremendous pressure from Trump, do you know about, what's her name? What's this thing going on today? I can't remember the woman's name who's, what is this? Oh, it's the wrong thing. The other Fed person that he wants to fire. Boy, talk about focus on the Fed, right? Trump suddenly tries to fire one of the other Fed people. And here we go. Seems to be the bottom. Not that. Cook. Lisa Cook. That's what's her name. And you know about this Lisa Cook thing. Hey, oh, that's good, because because Bodie was all over this, and let's get Warren's all right. Am I being bad here? Am I influencing him? So with all this tremendous pressure from the Trump, and do you know about this Lisa Cook thing? So I'm not going to tell him how I feel about it. Do you still think the Fed will not cut in September? Even just to appease Trump? How so? All right, I think that's a fair question. I'm not being anti or anything like that. Trump pressure and the Fed's decision-making. Political moves Lisa Cook on the fire. President Trump is actively targeting Cook for calling for her resignation of unverified allegations. I agree, but it's just funny he comes to that like immediately. That appears to be part of the broader pressure campaign to shape the Fed board, potentially replacing long-tenured Biden appointee with somebody more dovish and aligned with policy preferences. This move signals an intent to exert political influence over the Fed's composition and by extension its policy direction. I did not tell him that. Will the Fed cut in September just to appease Trump? Short answer, no, not likely. Holy shit. Independence remains paramount. Despite Trump's intense pressure, the Fed's independence, both structurally and normatively, remain firm. Powell has publicly confirmed that he cannot legally be fired by the president. We know that. The Fed pushes back, and not just in word, but also through cautious policy steps. Data still speaks louder than politics. September is not out of the question as markets overwhelmingly price it in, but Fed officials are clear that data, not political noise, will drive decisions. Recent weak labor data strengthens the case for easing, yet inflation and tariff-driven uncertainty remain significant constraints. Not all Fed officials are pushed by politics. Many remain internally divided, torn by, well, it depends on if they have a mortgage or not. Many officials remain internally divided between inflation and risks, and specifically through tariffs and economic weakness. Some favor tariff cuts, some favor cuts, but most remain cautious, waiting for clearer signals. What's the role of Trump-linked appointments like Cook? The attack on Cook is clearly strategic. Removing a dissenting or less aligned voice gives political payoff for shaping future policy, but the Fed's current Governor Powell and most of the committee continue to anchor policy to economic fundamentals, not executive pressure. As noted, market forecasts strongly weigh a September cut based on slowing job growth. Analysts like Barclays remind us the Fed would prefer to retain optionality and avoid premature moves under external pressure. Final take September cut. Like this, the scariest thing about this was I don't know if it was Ludnick or Bessent or whoever. They had some Trump. Oh no, it was Pulte. That's right. Sorry, it's Pulte. Pulte was on TV. That's why I wrote this thing in the chat room before. Pulte's on TV. He's the head of the housing stuff, and he is just making up bullshit against Lisa Cook. That's why I wrote that article and sent it out by Twitter and shit, because I want reporters to know how to defend the poor woman. And Bodie and I were like doing fact checks on it and being like, that's bullshit, he's full of crap. It was horrifying. And so it's not about whether Lisa Cook did something wrong on her mortgage application. It's about the whole concept that these guys are willing to use the government machine to grind down anybody who they feel is in their way. That's freaking horrifying. That's what bothers me. The government is a weapon. And it's a weapon in the hands of Trump and those people. Final take, it shouldn't be a weapon, but it's being used like one. September cut, likely, what? Yes, a September cut is becoming the market's base case. How did you suddenly get to that? Driven by labor sovereignty. No, it will not be a capitulation to political pressure. The Fed remains disciplined. Oh, wait, have you changed your mind? Have you changed your mind? Before you said no. September cuts. All right, summary. Oh, he does summarize it here. Trump pressure amplifies scrutiny but lacks formal leverage. Economic data still the primary driver. Fed independence, strong institutional norms protect against political force. Market expectations very high for a cut based on data, not politics. Let me know if you want a probability curve. Blah, blah, blah. Well, sorry, let's go with this question. He sort of said it, but great question. I feel good. Okay. I feel vindicated. No September cut, base case first cut in November at the earliest. Well, run out of year. There's no more time left if they don't do it by then. Language was cautious, not urgent. Inflation was described as somewhat elevated, no strong. What's changed? July minutes revealed deeper internal division, too formal to sense. Multiple participants acknowledge inflation is close to target if you exclude tariffs. But how can you exclude tariffs? Explicit debate about how much longer they can delay a move. Inflation is flattening, not re-accelerating. Goods inflation driven by tariffs, not demand. Okay, but what's the inflation's inflation? Services inflation cooling. The Fed staff revised tariff pass-through assumptions down. They expect less inflationary targets over time. Whose staff is that, though? Labor market is weakening under the surface. Higher Black youth unemployment. Reports of businesses holding off hiring. Political pressure has intensified. While I maintain that the Fed won't cut to appease Trump, the political cost of inaction is rising, especially Fed independence, not total immunity. It's a negotiation with credibility. Updated view. Probability of September cuts. Oh, he's kind of on the fence, but okay. So why the change? I agree. This is my theory too. I'm like, what do you, other than the credibility of the Fed? Oh, okay. This is important though. I kind of agree, but I kind of agree, and I'm saying other than the credibility of the Fed, what's the harm of a 0.25 rate cut in September? I don't think Powell is, this is a bad keyboard to type on, it's really flat. I don't think Powell is big on dick swinging. So maybe it's the right political appeasement, though 0.25 won't calm Trump down, but better than not. Meanwhile, though, the Fed doesn't work for Trump or the government. They work for our banking cartel. So, WW. Did I spell Jamie Dimon? Something like that? Jamie Dimon do. I swear that's how his name goes. Demon. All right. Yeah, CPI is a big thing. Also, I think there will be pressure from other central banksters at Jackson Hole for Powell to go down, fighting for the team. There you go. Make them think. See that? Doesn't come right back with an answer on that one. It took him 2 seconds. You're speaking the language, how the system really works, not how it's supposed to work on paper. Let's unpack from all three angles. Now we're having a conversation. What's the harm in a 25% on paper, small cut, small risk, doesn't material loosen conditions, could buy goodwill from the markets, politicians, and global peers? In practice, credibility is the key currency. I agree. A cut with inflation is still above target risk, appearing politicized, undermining forward guidance, triggering expectations of more cuts. That's true. But this assumes the Fed has a ton of credibility left to spend. Arguably, it already used it in 2021-22, lagging behind the curve. Your take, and I agree. What's the real harm if the Fed is seen as proactive instead of reactive? The truth is very little if it's framed right. A mid-cycle adjustment to preempt slowing labor and tariff noise. That's how Powell justified cuts in 2019. 2, the Fed works for a banking cartel. I did spell it right. The Fed works for a banking cartel, so what would Jamie Dimon do? Let's get real. The Fed's actual constituency is the stability and profitability of the financial system, and JP Morgan, Citi, GS are the core nodes in that system. Jamie Dimon right now wants 3 things. He wants a soft landing, not a rate-induced credit contraction. He wants predictable liquidity, even if not abundant. No market freakouts before election season. Okay. Would Jamie support a 25 cut? Yes, if it stabilizes forward expectations, if it keeps credit spreads tight, if it doesn't spark a dollar dump, that's also, by the way, a big danger, or a commodity spike. He doesn't want chaos, a small non-committal cut with data dependence plastered all over it. That's cartel friendly. Global central banks and Jackson Hole dynamics. Jackson Hole is going to be a pressure cooker. Powell is not walking into a sympathetic room. Other banks are tightening or in early easing phases. Emerging markets are struggling with capital flows. Central bankers will want Powell to join the team in global coordination. If Powell digs in and doesn't cut, he risks reinforcing dollar strength, worsening the outflows. Further divergence fractures the soft landing narrative. If he signals openness to cuts, he gains goodwill with foreign counterparts. He reestablishes the Fed as the leader of the choir, not the odd man out. So you're right. Powell isn't a policy ego guy. He's cautious institutionalist, and for that reason, a credibility saving cut in September may be the least disruptive option. It lets him say we're responding to the data, we're watching the tariff noise, we're still playing. I think that's the way to go. If it was me, I'd do the 25 cut. But It's very hard to do it because of what Trump is doing. It makes it look like you're caving. Fed's job isn't to make Trump happy, but it's to protect the system's stability and credibility. A small cut could serve all factions, politicians, market players, and global central banks. Want me to model out the September cut, November cut, no cut, and how I'd like to see you try. I'd like to see you try. Making smart ass. It's like, great, I could do that. All right. Let's model out 3 different distinct Fed policy modeling. 25-point cut, labor market weakening, inflation, Jackson Hole, market impact, Treasury, slight drop, dollar weakens 1 or 2% more. Oh man, Jesus Christ. Equities rally. Okay, if the dollar's going to weaken, that's going to happen. Macro message, Fed in control, Powell stays above the fray. September, November cut, wait and see, hold in September, if he holds in September, I don't know if the fallout from Trump is going to, if there's going to be a November. Labor data deteriorates, tariff September, is too sticky, Powell maintains. And then he's going through the things. Macro, Powell buys time to preserve credibility. The Fed is still nimble. So number 3, the fortress Fed holds. Okay. So given our morning report, where do you land with the bond vigilantes? Okay. There's a big problem with GPT accessing the web, because this was not a problem before as much as it is now. He seems to be able to not read a lot of things. And I mean, frankly, from a chat GPT perspective, I don't see why they think it's better if I have to frickin' paste things in all the time. The bond vigilantes are back and forth, but they're not fighting inflation. They're fighting artificial rate suppression. Yeah, that's what I'm talking about. Amid massive rollover, and if Powell cuts in September without inflation collapsing, they may revolt, not because they hate cuts, but because they smell monetization. Yes, 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 that is what I'm saying. What vigilantes see, the debt, blah, 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 the market, blah, 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 and the PPI spiking. This is not a recipe for stable demand of treasury auctions. Who's going to buy 10 trillion in debt at artificially low rates? That's the war cry. If they don't want higher yields because they hate Powell, they want higher yields because they don't trust that lower rates will reflect price discovery. What happens if Powell cuts in September? If done cautiously framed as calibrating due to softness, the long bonds may temporarily, if CPI and PCE softens. That's the key. That report is going to be life and death. But auction coverage ratios and bid to cover will deteriorate. Foreign buyers will demand more yield premium to offset current. If the markets smell political appeasement, then we can go over 5%. We're just at 5% on the 30 right now. September is sticky. Powell downplays PPI. Trump amps up the pressure. The curve, this is not a risk-on pivot. It's more like 2011, steepening due to loss control not easing. That is my big fear for the Fed. My current view, A Fed cut in September is more likely than not, but the real risk is what happens after the cut is already priced in. The disappointment is asymmetric. A hawkish hold could shatter liquidity, but the worst outcome is a cut without commitment to discipline, which obviously we don't really have. But when the vigilantes revolt, not because Powell acted, but because he failed to signal that he's still in charge. Well, that's interesting. Framing. September cut arts, 55 to 60%. See, now I feel like we had a good conversation and we can take this chart very seriously because we really looked at all the factors. That's very important when we do these things. Vigilante risk, high if it appears politically motivated or poorly messaged. Inflation threat is real, but increasingly tariff-based, must be disentangled. Dollar fragility is significant, the weak dollar, and rate cost risk outflows. Long in demand, softening fast, weak auctions, the Fed is boxed in. Jackson Hole stakes are enormous. Powell must sound like an adult in a room of children. Would you like a tactical trading metrics from this showing how positions in FX, credit, and equities across various outcomes? No, thanks, but a great discussion. All right, and now we have now I feel like we're in good shape. We know what we're watching, and then next week when we come back, we will update. The other thing of doing these, of keeping these separate instances open of GPTs is that it's specifically for this purpose. Like I've got a GPT for this conversation. I will get back to it next time something significant happens and he will be right on top of it. Plus he can search the web and catch up on current events. All right, so that's where things are. I'm out of throatability, so that's the end of my words. But thank you everybody for coming. I appreciate it, and we will do it again next week. All right, thanks folks, and we'll see what new information we have for Warren. So as we close in, we should get better and better vision of what's going to happen. All right, thanks folks.